Welcome to the YouTube Business Channel Investment. Today we are pleased and excited to invite you to follow an exclusive interview with Mr. Matthew Merle. Matthew is the managing partner of Fifth Era Capital, Blockchain Coinvestors, a fund of funds investing in blockchain technology. He is also the managing partner of Keiretsu Forum and Capital. Keiretsu Forum and Keiretsu Capital are ranked as the most active venture investor in the world and back 180 companies. Matthew is not only an investor, he's also a best-selling author. I invite you to look at his novel, and you can see here, by the way, and look at the link under the video where you can find in Amazon. And I really invite you to look at some of these books, such as Second Chance. It's a really interesting science fiction novel, and other subjects such as innovation and blockchain. We hope you're going to enjoy this interview full of really interesting feedback and experience for a savvy entrepreneur and investor. And don't forget to subscribe to our channel because a lot of more podcasts and interviews are going to come. And see you right after this. Hi, Matthew. This is a great pleasure from Business Channel Investment to welcome you in this video channel for the investor community we have. We selected a profile because of your great experience in the startup investment ecosystem. We would like to know more about you, and we would be really pleased to, if you could introduce a little bit, talk about a little bit about you for 5 minutes, what's your experience, where you're going from, and what you're doing today.
Thanks a lot, Hugo. Well, it's great to be here. And I think you know, but your audience may not know, that I'm based in Silicon Valley, and I'm one of the principal managers both at Fifth Era, which is my family office that invests in early stage tech. We've been investing for 20 years here. But I'm also managing partner of Keiretsu, which is the leading early stage tech investor organization in America. It's the biggest angel group in the world, and we have chapters up in Canada, in Vancouver and Toronto, also London and Vaughan. And then the third thing that I do is I manage Blockchain Coinvestors, which is the leading blockchain venture fund of fund. So this is what I'm doing today. It's all early stage tech investing. But in my past, I've written books, and I was a management consultant at large consulting firms. I was with McKinsey and Carney and Booz and Monitor, always here in California, running the West Coast.
Okay. You were talking about fund of funds, about early stage. Would you mind to tell us more about that? Because it's quite different from, VC itself. How do you find the capital, or you organize this, and how do you work with your investors?
Thanks, Hugo. So Keiretsu has several different ways for people to participate. Anyone who's an accredited investor can become a member. It's a member organization. And then you share your deal flow, and you look at the deals that other people, other members are bringing to the network. So that's the first way. You're making direct investments. You're an angel investor. You're doing it yourself. The second way is to put your capital into a fund, and that could be a venture capital fund. In the case of Keiretsu, we also have co-investment funds. And so sometimes our members put money into the fund, and then it's spread across 40 or more of the companies that have been backed by the angel group. The third approach is to be an investor in fund of funds. And what happens there is we're creating a vehicle, an investment vehicle, so that we raise capital into it, and then we give that capital to fund managers, venture capitalists. And that's a good approach if you want to gain broad exposure globally, because you can't be everywhere making your own investment decisions. So if you want to invest in Europe or China or other parts of the world, a fund-of-fund vehicle can be helpful. And also if you want access to investors or opportunities that you don't normally see, that you don't normally have access to. And so in the case of blockchain, we created a fund-of-fund vehicle because we wanted access to the leading blockchain venture capital firms in the world. And through that strategy, we are investors in 10 of the 16 blockchain unicorns, Coinbase, Kraken, Ripple, Definity, Figure, companies like this.
Robin Hood. That's what I saw in the website. Yeah. And this is really interesting because maybe the people who doesn't know you or never went in your website. I mean, I saw 13 unicorns. It's the top. I don't know how you make it, but you selected the top of the top, and you can be sure that in the 13 you got result. So this is a proof of it works. And there is on the back end business intelligence.
That's right, Hugo. But some of a small number of those unicorns, we were direct investors into them. So we're direct investors in Ripple, as an example. But most of them, we invested through venture capital firms. So we gave our money to Blockchain Capital, DCG, Castle Island, Fabric, and they invested the money into the unicorn. So I just want to emphasize that point. It's not we are indirect investors, but obviously our community, our investors, sometimes want access so they can put their capital in, and you don't always have direct access.
Okay, so it's basically what you just told of the fund of fund.
Yes.
And after you use the VCs as a kind of master node with their business intelligence to invest, but you're doing the selection of the VCs to make sure they maintain the high quality for your peer, private, limited investor, and so on. I have a question in terms of the selection of the investors. When you're talking about this fund of funds, most of the investors, okay, can I invest? Can I contact you? Or do I really need to be a business angel or a big guy? So even if I have $10,000, can I knock at your door and say, hey, Matthew, I'm really interested in what you're doing. I follow your company. You think I can make the weight with you? I can give you 10,000? Or do you say, no, get back with an association, and with the association, I'm going to bring us 100,000?
Yes, so it's a good question, Hugo. And depending upon what jurisdiction, what country you live in, the rules differ. So I'm based in America, and in America, these types of investment opportunities are hard to access unless someone's an accredited investor. And an accredited investor means that either you have $1 million of net worth, or you earn more than $200,000 per year, or $300,000 per year with your spouse. If you meet those criteria, then you can be an investor in these types of opportunities.
Okay.
The second question is then, should you invest? And this comes down to your wealth, your risk profile, the degree to which you're willing to risk money. And this is high risk investing. Early stage tech is always high risk investing. And then the third is the specific approach. So in the case of our blockchain fund, we have partnered with Linkto, Linqto. It's an app that you can find. It's like Robinhood or Coinbase, except that it's for private companies. And you can invest in our fund smaller amounts, $10,000, through Linkto. But if you want to invest more, $100,000 or more, then you come direct to the fund.
Okay. Yeah. I understand. So your fund of fund is really specialized in blockchain. Would you mind for the community, what do you think today? Because for the last 5 years, the technology improved, still not mature, but we saw a lot of improvement in itself for some solution. Ethereum did its own evolution. We have Bitcoin that not improving a lot, but we have a crypto market kind of unstable, but that's quite understable. What do you think today about the market based on the ICO and initial exchange offering and the STO? Because we have two different trends, and the STO was delayed because of regulation concerns, but also because of the quality of the project. So what's your viewpoint in such ecosystem, and what's your strategy?
Thanks, Hugo. So I should say, by the way, that I will talk about our investment strategy as I just did, but I'm not allowed to talk about the specifics
Yeah.
of our investment vehicles on this type of a webinar.
Yeah.
But anyone that wants to learn more and who's an accredited investor, they can reach us and
Sure.
we can talk more. But this is just the general solicitation rule issue in America. But so to answer your question, I actually don't begin with the investment vehicle. I begin with the underlying fundamental changes that are making new technologies and new companies attractive. And so if to answer that question, your question, I would begin by saying that over the last 20 or 30 years, we have built out a lot of our new digital world. We've embraced the internet. 6 billion people or thereabouts are online. We share communication and commerce to some extent, but we haven't finished that work. And in the next 20 and 30 years, we have to complete that work, or at least make it even better. And some of the things we have to do is we have to make it more secure. We need better forms of identity. But most important, we need native digital monies and native digital assets. And I believe, everyone from governments to large companies to the distributed investor and technology community, they all agree we need digital monies and digital assets for a digital world. And so as an investor, I'm interested in investing in the companies that are either building the foundation layer of technology to support global digital commerce. So that includes the compute, store, share, secure technologies that we're going to need in this new digital world. I'm interested in all of the transactional layer companies that are building the wallets and the exchanges, the settlement systems, all of the ways that we're going to use these digital monies and digital assets. And I don't really care whether it's the Chinese digital yuan or whether it's Bitcoin. They're both digital monies and they both need new digital infrastructure. And then, of course, there are application companies built on top of all of this technology. So Alison, my wife, who is also my business partner at Fifth Era, Alison and I are investing heavily into the next generation of fintech and blockchain and technology companies that are using distributed ledger to help us all move into the digital economy of the future.
This is an interesting point because we're seeing in the market different level. I should just explain really clearly with the infrastructure, the application level, and so on, and the orientation for the new digital economy with the e-commerce, but more specific for the bank, for the how you use the new digital currency, which is basically you forecast the close future, what's going to happen. We saw so many projects with applications, but poor services. So my understanding is you want to focus on infrastructure, the hardware, I might say, and really specific application related to this hardware that makes sense. Not a simple application, just we are doing an application based in blockchain because you're just using a layer of it. We want something stable, scalable, and based on a truly new technology.
So I'd say, Hugo, I think that ease of use is a function to a large extent of experience, user experience. Most technologies, when we first introduce them, are not easy to use. And then people learn what users need, and they also learn how to make things simpler, and they build, reusable pieces of code or application that over time make the application easier and easier to use. And so I'll give you an example. When we all first began to use the internet, we would use Prodigy or the first America Online, and it wasn't easy. It was very hard. You plugged into the telephone, you had to download software. It took forever to load. It sometimes crashed. You couldn't get the content to appear on your computer. It was not easy. Today, it's so easy. Anyone in the world can go into an easy and accessible browser, put in a search and get some information. It's very easy. And that can be streaming video just like we are recording today. So the quality of the interaction and the content has gone up exponentially. Well, the same is true in blockchain. When Bitcoin was first introduced, it was very hard. I tried back in 2012 or so to buy some Bitcoin. I tried to open a Dwolla wallet. I couldn't get the wallet to, I couldn't get them to open an account for me. I couldn't figure out how to make the wallet open. I ended up not buying any. Alice and I ended up buying some Grayscale GBTC instead, because that was easier. But today, it's quite easy. Anyone can open an account at Coinbase or Kraken or SFOX, and with 6 clicks or thereabouts, you can have an account, and then you can buy and sell and hold digital monies. And so I think that user experience improves over time, and we make things easier to use once we understand what it is that how users define ease of use, and that this is all an evolution.
I fully agree with you, because I just heard about what about your experience in terms of when you want to buy something, you have to get through the wallet and so on. And I got the same. At the beginning, it was a nightmare for me. I was rushing to pay the crypto. It was quite the same. It was also an interesting point. It's, as you just said, the end consumer. At the end of the day, the end consumer is a seamless experience, make it easy and easier. And what I saw the last 3 years, a lot of blockchain solution, it's really complicated to use it. They forgot completely, some of the project forgot completely the end user, because they just want to sell a token or sell a solution and not to put their feet in the shoes of the end consumer. And I think it's changing. It's exactly what we are seeing, I think. And it's amazing the comparison you did with the past, from, let's say, the 2000s, and we got the same. And now we got blockchain, and blockchain on a rush, the technology rush, no maturity. And now we are seeing new solution. People are focusing on the hardware, but at the same time, those who are already in the ecosystem, in the established market of crypto exchange, for example, are focusing on the end consumer experience to make sure that they boost the adoption also, because the adoption is a concern, and adoption is based not only about regulation, but, as you just explained to us, end user.
Yes. And we, going back, you had also talked about ICOs and STOs. I think that the ICO boom and bust was very interesting to me. On the one hand, I think it's a very interesting proof of concept. It demonstrates that technology can allow investors to invest globally in offerings without, just using technology. That is very interesting. And I think as we roll out digital assets, security tokens, as Securitize does, which is where I'm chairman of Europe, we are going to see those offerings very easy to access for people around the world. The issue is, the other side of that is, this is investing. So to be a good investor, you have to do a lot of work. You have to do a lot of due diligence. You have to be very thoughtful. And I feel like in the ICO wave, we threw out the best practices. We abandoned the best practices of early stage investing. And a lot of people lost a lot of money because they didn't do due diligence. They didn't know who they were interacting with. And technology was allowing them to get excited, but they weren't doing the hard work of making sure that the investment was a good one. And I think that we don't want to make that mistake again. So as we think about security tokens, we want technology that's easy to use, but we also want high quality investments, because the goal is not to make it easy for bad people to offer bad offerings to investors who obviously then will lose their money. So, and then it also all needs to be operate within the regulatory regime, and it needs to be compliant within the jurisdictions in which the investor is based and where the offering is coming from. And that is a lot of work. It's a lot of work to make all of that work.
Yeah, I agree. You made a good point, because I got a discussion with investors and a really savvy entrepreneur is with your Andrew of age, and it's just seeing one thing. There is a technology evolution. We have the concern of the regulation because we have to be compliant, but also you have the business rules, and the business rules cannot change. You need to follow a standard process to make sure that the business is in a good basis. You can put all layer of technology. You have to make sure the structure of the company is really strong. And I would like to ask you another question based on what you told us is, what do you think in terms of when you were investing or still investing, I'm not talking about the fund of funds, but if you see a blockchain company, for you, what's the major and top criteria you are first looking at when you see
Right.
the project?
Yeah. So I think that for most early stage tech investors, it's a fairly predictable list of criteria. And the criteria, the same criteria that venture capitalists will normally explain. So it begins with a very talented team, hopefully people who understand not only a technology, but the use cases, who are able to put together real valuable products and services, and hopefully have some experience building companies, because being an entrepreneur is a very tough career, and very few people are good at it. It requires a lot of skills. So good entrepreneurs and good teams of entrepreneurs are hard to find. And in blockchain, I think that's even more true, because blockchain is a new technology. And so the people that really understand it may not have worked with and built businesses in the past. So that's the first point. After that, the list is quite predictable. It's, is there a big opportunity? Is there a big pain point? Does the proposed solution really fit that need? And is it going to be scalable? Is it going to be defensible? Why do we think this team is going to win relative to other teams or even larger companies that may try and do the same thing? There are questions about the financials. How much money will it take to back the business? How long will it take to get to a viable cash flow positive situation? How much money will need to be raised in the interim? And there are questions around exits. As investors, we don't make money until some sort of a liquidity event occurs, which in traditional venture investing is going to be either a corporate acquisition most of the time, and very rarely a public offering. There are other approaches, dividends and so on. Now, in the world of tokenized assets, it is possible that tokens could be distributed and they might be tradable. So that is another way to gain liquidity. So these are the main, there's a couple of others, but these are the main criteria that an angel investor, an early stage tech investor is looking for as they do their due diligence. But I would say the two main ones in blockchain specifically, one is this a great team? And do they really understand the blockchain and distributed ledger technology? And are they using it in a way that makes sense? Because we don't want to be technology first, we want to be use case first. And there's plenty of applications where you don't need blockchain, you could use a database or something else. And then the second is how good are they as engineers and computer scientists? And this is where I'm not very good. I can't do technical due diligence on blockchain teams. So part of the reason why we created our fund of funds was because we wanted to be investing with the best venture capitalists in blockchain. And those people are very capable of doing due diligence on teams and their blockchain expertise. And we thought that it'd be better to trust their knowledge and expertise than to try and create it ourselves, because we don't have that level of computer and technological sophistication in-house.
Okay. And concerning the numbers, you just told us about the vision, the investor vision, about how much they want to raise and so on. And from this point, I'm really curious about what's your perception, your standpoint about okay, we are a startup, and you go over the numbers and the financial projection, and moreover the expense projection, and you see they just need $1.5 million, let's say, to go to market and finalizing the MVP and with the feedback from the users and so on, and they ask for 5 million. So for you, is it relevant to ask 5 million when you see in the number they need 1.5 million? So what's your perception of the amount raised and requested by your startup?
Yes. So Hugo, it's the challenge here is that this is changing, and we're in a new world of digitized cryptocurrencies and assets, and the ability to incentivize large networks and populations of people. And things are possible today that historically weren't possible. I lived through the dot-com boom here in Silicon Valley, and I never really understood the valuation of startups and how so many of them got so much money when I couldn't imagine myself how their business ideas could become viable. Now, sometimes I was right, sometimes I was wrong. Obviously, over time, we began to understand the power of network effects and how building scalable global technology businesses could be, in the short term, might use a lot of cash, and those companies might be cash flow negative for a long time. But ultimately, if you become an Uber or an Airbnb or something like this, you're going to be worth a lot because you've built a very large and important business. So discounted cash flow analysis and business plan and cash flow analysis isn't the only way to get funded. By that line of approach, which I think most angels subscribe to, startups need to justify the money that they need to raise. They need to be able to show that they're going to create revenue and they're going to have well-managed expenses, and at some point they're going to be cash flow positive. And the investors are going to do the calculation on how much equity capital or other forms of capital, non-dilutive financing potentially, are going to be required to fill the hole. So we're going to have a startup over time. It's going to need to raise some money to get to the end of the business plan that we're all shooting for, 3 and 5 or whatever it is years out. We normally say that startups should think about funding not as an event, but as a series of events. So you raise some money at the beginning, you raise some more money, and some more money. And that might be called the formation round, the seed round, the bridge note, the Series A. It's just-in-time financing, not just in time. You're raising the money before you need it, but you're raising small increments. So Hugo, if you said, I've got a business idea, it needs $5 million to be viable, I would probably say, well, why don't you raise $1 million now, $1 million next year, and $3 million the year after? Don't try and raise 5 million all at the beginning, because angels won't give you 5 million, and VCs probably won't either. They'll be more milestone driven. Everything I just said is my conventional wisdom, 30 years in Silicon Valley. The problem is I've been wrong a lot recently. People have raised hundreds of millions of dollars, even billions of dollars, without a product, just with an idea and with a passionate network of people. And that isn't the way it normally works. So yeah, so if you can be Block One or Ethereum for that matter, and if you can create a tokenized a valuable token, either a utility token, there's going to be very few of those, I think, in the future, or a security token. And if you can get a large population of people to get excited by your project, and if they're willing to support you by buying what you're offering before you even have a business, then who's to say that that isn't the best approach? In which case, $5 million sounds like a very small amount. To angel investors, 5 million sounds like a lot. At Keiretsu, where we back 200 companies or more per year around the world. The average round where we participate is typically 1 to 2 million, 1 to 3 million, let's say, US dollars. And Keiretsu members are maybe giving $600,000 or $700,000 on average. And other investors are giving the rest of the money. So this sounds like small amounts when you compare it to some of the blockchain offerings where hundreds of millions of dollars have changed hands.
Yeah, it's apparently it's a case per case in terms of 10 million or 20 million. And what I'm surprising today is to see a lot of startups coming to us say, I want to raise for the seed $5 or $10 million right away for the seed, not for the Series A. So, and even they are close to finalize and approve, they can execute the solution. Could be a serious solution, right? Kind of mobile payment system based on, I might say, Stellar platform, for example, technology. And they have to prove they have the traction. They have to prove they're capable to reach the market. Because at the end of the day, it's the last judgment day, I might say, it's the market. So how the heck to ask $10 million when you just need 2 million or maybe 1 million, depending on the complexity of the technology you're developing and the approach. It's
so Hugo, the reality is we shouldn't, I mean, your audience are either entrepreneurs or investors, probably.
Yeah.
They either have something that they want to do, or they're investors who want to help other people do something. And it's dangerous, in my opinion, to talk about the exceptions. Here in America, we back the angels and VCs together, back about 85,000 tech companies every year. Those 85,000 companies mostly go through what I described, a multi-stage funding process that begins small, a few $100,000 to get the company started, a few more $100,000 in the seed round, a bridge note of some description in the 1 to 3 million area, and then perhaps a Series A, if they're lucky with a VC or with a family office, maybe $3 or $4 or $5 million. This is overwhelmingly the reality for entrepreneurs. And most people watching this, if they want to be entrepreneurial, they need to be good at multi-round funding, and they need to understand the milestones they need to demonstrate to raise capital. And they have to work really, really hard to raise that capital, meeting a lot of people and being rejected most of the time. If we talk about, Telegram and Gram and $4 billion, it's not going to help most people. It's most investors don't participate, and most entrepreneurs aren't able to do that. What's very interesting is, in a global connected world, it is possible to get large numbers of people, hundreds of thousands of people, to get excited by your offering. And if you can do that with technology, yes, you might be able to raise a lot more. But those are the exceptions. And even in the whole ICO and the dot-com wave before that, you're talking about at most dozens, maybe hundreds, but not tens of thousands of entrepreneurs that raise money that way. So if anyone's watching this and they can be the next Vitalik Buterin, and they can create the world's best blockchain ecosystem and protocol, then of course they should try and use technology to raise their money. But I would argue that almost every entrepreneur listening to this should learn the basics, raise your money from friends and family, approach some angels, and go through multiple rounds and scale up over time.
Yeah, it's exactly the feedback I have from when I know with all the entrepreneurs I'm working with, and they are completely panicking because they were dreaming to get million and million and million because of the blockchain hype. And now the market is soaring, and it's back to the, I might say, to the normal, and they have to realize that they have to work harder, as you just said, to get funds. They have to be more to implement some discipline and structure and process within their startup to prove that they can deliver, how they're going to deliver, for who, what kind of market, and step by step why they need so much money, and for what, how they're going to use it, and when the investor can see his return of investment to something more, I might say, business.
Yes.
More professional, I might say.
Yes, and we can talk in a minute. Maybe we should talk about the cycle and where we currently are, because I think for most entrepreneurs, things are changing this year, as they have in the past, and we could probably talk about that if you want as well.
Yeah. So in this meeting or in another meeting, because it's a lot.
Okay. No, I was just, I didn't know if you had another question. So let's talk about that. What did, yes,
do it.
Exactly. 2020 is a recession year. We already know that. It's a global recession. It's a pandemic-driven global recession. What do we normally see in recessions when it comes to early stage tech investing? And the answer is fairly clear. 2001, 2008, again now, and it's also been true in the 90s too. Certain things happen. The first is it becomes harder to raise money. Investors become more difficult to reach. They are more concerned about investing. Many of them have seen their own balance sheets and their own net worth shrink if they're angels and family offices. If they're venture capitalists, they have to continue to support the companies they've already backed. And they're now worried that those companies will need more capital. So they're less likely to back new companies. Secondly, valuations come down. That doesn't happen straight away, but within the first 6 or 9 months around a recession, the valuations begin to fall. And that's a reflection of the fact that it is harder to raise money and less money is available. Plus, the investors are becoming tougher and they're asking for lower valuations. Thirdly, there is typically a large cleaning out of marginal startups and portfolio companies. So companies that were sort of limping along, struggling to make their business work, raising more capital to keep going, those companies suddenly find they can't raise the more capital. The recession may actually reduce the need for their business or their product or their service, and they go out of business. So those things are sort of hallmarks of what we see in the year following the beginning of a recession. And that's all ahead of us still. Now, there's some silver linings, and here are the silver linings. For investors, of course, the lower valuations means that they can potentially make more money. There's a lot of evidence that shows that the venture capitalists themselves get higher returns from the funds they raise and invest in after the beginning of the recession. And that's partially because they are getting low valuations. And the other part of it is because the companies have less competition. The companies that do get funded have less competition because a lot of companies can no longer get funding and go out of business. So that's another point. And then, and this is, I think, a little bit different about this crisis than prior crises. 2001 and 2008 were financial crises. This is more of more of an economic crisis created by a pandemic. And as a result, there are some things happening right now that I think are very, I mean, obviously it's a terrible time and it's a terrible crisis, but they're very exciting for technology investors. And that is that the adoption curves of almost all of the digital technologies we've been working with have just been accelerated. So we're working electronically from home, digital educational, digital health, remote learning, remote entertainment have all gone up. Digital payments, electronic commerce, the use of digital monies instead of paper money to pay for things have all gone up. And I don't think they're coming down. I think that what we just did was we were working the early adopters with these new technologies and struggling to get the mass of the population to come on board in some cases. Now the laggards have no choice, right? Even if you hate your computer and you hate communicating electronically, you don't have any choice right now. So the laggards have got to embrace these technologies too. And I think some of them will say, well, once this crisis is over, I'm going to go back to the old-fashioned way, and I'll use my phone and I'll write a letter. But I think the vast majority of the population will have experienced different ways of doing things, and they won't go backwards. And I know that was my experience. You know, I started using Amazon a long, long time ago, but it took me a while to appreciate just how amazing it was to have all the billions of products available at my fingertips that I could buy and have delivered to my home. Most of America doesn't use Amazon. So Amazon is the biggest electronic commerce company in America, but most people still don't use it. Well, that's going to change. That's changing as we speak. So anyhow, I'm saying all of this because if I was an entrepreneur, and I think most of your audience are entrepreneurs,
Yes.
I would be very worried about valuation, raising capital, and the business environment. But I'm trying to give you some reasons to also feel very excited, because your vision, your ideas are probably even more relevant today than they were in January, because the world is changing very fast in favor of the digital economy.
Thank you very much. Thank you very much, Matthew, for this insightful conclusion of these interviews. It was really rich, and on behalf of all the community investors and entrepreneurs, I thank you so much. Thanks for that.
Thank you very much, Hugo. I enjoyed being with you. Goodbye.